Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. The Federal Reserve meets September 18th, 2026, and markets are already pricing the move. Federal funds futures show a 94% probability of a 25 basis point rate cut, with just a 6% chance of a 50 basis point cut. That's according to recent analysis from Investopedia covering Fed interest rate expectations and stock market implications. This isn't speculation anymore. It's positioning. The question isn't whether the Fed cuts, it's how markets interpret the messaging around that cut and what it means for your allocations across equities, fixed income, and digital assets. Let's start with what's driving these probabilities. Fed Chairman Kevin Warsh made it clear in the July 2026 meeting that the committee is ready to act. As reported by CNBC's Fed meeting coverage and highlighted by Chase, Warsh stated, quote, "I want to stress, of course, that decisions by this committee matter a great deal, and where necessary and appropriate, we will not hesitate to act," end quote. That language signals intent. The Fed is watching inflation data, jobless claims, and broader economic indicators, and they're prepared to move when conditions warrant it. Right now, conditions warrant it. Inflation has moderated enough to give the Fed room to ease without appearing to capitulate. Growth data shows resilience but not overheating. The setup is textbook for a 25 basis point cut in a non-recessionary environment. That distinction matters enormously for how you position portfolios. According to BlackRock's analysis on Fed rate cuts and potential portfolio implications, equities tend to perform well during non-recessionary rate cut cycles. Their target allocation team actually increased their overweight position in equities during their September rebalance, based on historical performance patterns when the Fed eases without an economic contraction in the background. The key word there is non-recessionary. If the Fed cuts because growth is slowing dangerously, that's a different trade entirely. But current data doesn't support that narrative. What we're looking at is a Fed that's normalizing policy after an extended period of restrictive rates. That's bullish for risk assets, particularly equities. But not all equities react the same way. Large caps have historically been more resilient during Fed easing cycles. Small caps, on the other hand, are more sensitive to interest rate adjustments because of their higher financing costs and greater exposure to domestic economic conditions. We're already seeing emerging sector rotations as traders anticipate which segments benefit most from lower borrowing costs. Now let's talk volatility. Options markets are pricing in an expected move of approximately 0.6% in either direction for the S&P 500 immediately following the Fed decision. That's a modest but meaningful swing, and it reflects the uncertainty not around whether the Fed cuts, but around the tone of the statement and the forward guidance. If the Fed delivers what some analysts call a dovish hold, signaling caution instead of an aggressive easing path, the S&P 500 could move anywhere from 0.5% to 1%. That's actionable. If you're holding short-dated options or leveraged positions, that expected volatility is already priced in, and you need to account for it in your risk management. Treasury markets are where the rate cut dynamics get particularly interesting. Duration of risk in longer-dated bonds means that even a 25 basis point cut can trigger significant yield movements as fixed income investors adjust their allocations. We're likely to see yield curve steepening if the Fed signals a series of cuts ahead, or flattening if they emphasize a one-and-done approach. BlackRock's commentary notes that selective credit exposures might offer a yield pickup with lower volatility compared to traditional equity moves. That's a trade worth watching, especially for institutional players looking to capture income without taking on the full equity beta. For crypto, the implications are more nuanced. Analysis from Crypto.com and CoinLedger on how interest rates impact crypto prices shows that digital assets like Bitcoin tend to behave similarly to growth tech stocks when borrowing costs decline. Lower rates mean enhanced liquidity, easier access to capital, and a risk-on environment that generally favors speculative assets. If the market interprets the Fed's 25 basis point cut as a sign of easing inflation and improved liquidity conditions, Bitcoin could rally. But here's the catch. If the rate cut is accompanied by signals of broader economic distress, if the Fed is cutting because they're worried about growth, not because they have conquered inflation, crypto could fall alongside equities as investors rotate into safer assets. Bitcoin is highly sensitive to Fed messaging, and the reaction post-policy could be amplified by the tone of the statement, not just the size of the cut. Traders need to watch for subtle shifts in forward guidance, because that's where the real signal lives. Polymarket data on the Fed decision in September confirms what futures markets are already telling us. This is a high-conviction event with asymmetric risk. The 94% probability for a 25 basis point cut is baked in, but that remaining 6% chance of a 50 basis point cut represents tail risk that could trigger violent moves if it materializes. A 50 basis point cut would signal that the Fed sees more economic weakness than markets are currently pricing, and that would be a risk-off catalyst across the board. Let's break down the multi-asset implications. In equities, you want to be positioned in sectors that benefit from lower rates: financials if the yield curve steepens, real estate if mortgage rates follow the Fed lower, and tech if the growth narrative reasserts itself. Avoid overexposure to sectors that only work in a recessionary cut scenario, because that's not the base case here. In fixed income, look for opportunities in credit and shorter duration plays that capture yield without excessive rate sensitivity. In crypto, Bitcoin and Ethereum are the liquid proxies for risk sentiment, and they'll move fast on Fed Day. Be ready for volatility in both directions. What's critical here is understanding that the Fed's decision on September 18th isn't just about the 25 basis points. It's about the narrative the Fed constructs around that cut. Are they easing because they've won the inflation fight and can now support growth? Or are they easing because they're worried about a slowdown? The market will price those two scenarios very differently. As reported by the Federal Reserve's official FOMC calendars and minutes, the committee is weighing inflation data, jobless claims, and overall economic indicators. The data coming into this meeting will shape the tone of the statement and the dot plot projections. If the Fed signals a series of cuts ahead, say another 25 basis points in November and December, that's a green light for risk assets. If they signal one cut and then a pause, that's a more cautious setup, and volatility stays elevated. Institutional positioning is already reflecting these scenarios. The expected 0.6% move in the S&P 500 tells you that smart money is hedging both directions. They're not making a one-way bet on this meeting. They're positioning for the range of outcomes and managing tail risk. You should be doing the same. For traders, the playbook is straightforward. If you're long equities, you're positioned for the non-recessionary cut scenario where the Fed eases and growth holds up. If you're in bonds, you're looking for yield curve dynamics and credit opportunities. If you're in crypto, you're watching for the risk-on signal that comes from a dovish cut with growth-positive messaging. And if you're holding cash, you're waiting for the Fed's tone before deploying capital. The September 18th meeting is one of the most significant macro events of the quarter. The numbers are clear: 25 basis points at 94% probability, expected S&P 500 move of 0.6%, and sector rotations already underway. The catalysts are defined: Fed messaging, forward guidance, and economic data into the meeting. The opportunities are across asset classes: equities, bonds, crypto, and volatility plays. This is not a meeting to ignore. This is a meeting to prepare for. Position accordingly, manage your risk, and be ready to act on the Fed's communication. The rate cut is coming. The question is what the Fed says about what comes next. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.